Yeah, thank you very much. Everyone can hear me okay? Perfect. Yeah, and I think Pauline and I are fine taking questions along the way. If you have a burning question that we're in the middle of the slide and we're not answering it, by all means raise your hand and we can address it right there. So Impression Ventures. We're not going to talk very much about fintech today. Today is really about what are the economic incentives that drive the day-to-day decision making of venture capitalists. And so I would think a relatively dry topic, but it's kind of interesting when you sort of get into the structure beneath the door front, if you will. So we're Impression Ventures. We're established here in Toronto. We have an office, and my partner is in Montreal. We're currently deploying capital out of a $30 million fund. We only lead deals. We write checks between $1-2 million on average. So $1.5 million on average into sort of $2 to $5 million rounds. Founders can call that whatever they feel like calling it. We're agnostic. You want to call that a seed round? Great. You want to call that a Series A? Great. You want to call it something in between? Great. We don't really care. In fact, we care that you care in the sense that we understand that naming of rounds today is actually more of a marketing tool than it is than anything else. So we're happy to support our founders, not just on marketing, but in fact actually on all their activities. Part of our philosophy as a lead investor is to be there, week to week, day in, day out, as you need us, and we certainly hear that from our founders. As Simon mentioned, we're an early investor into Wealthsimple. We led the seed deals on basically every other deal that we've done, including Sensible, which is digital receipt management business here out of Toronto. Frank, I think, is in the crowd. I saw him representing from Sensible. Brim, which is a new credit card issuance platform that's just launched over the summer. You should definitely check it. If you're in the market for a new credit card, definitely check it out. Even if you're not in the market for a new credit card, you should definitely check it out. It's the best credit card program in the country by leaps and bounds. Fineo, which is a digital marketplace for life insurance products, but we're building an entire marketplace for insurance products there across the board. And then Cement is in debt recovery. We're applying essentially reimagining how debt recovery is done through the same engagement tools that customer acquisition channels are using today, which are not being used in debt recovery, to vastly improve, frankly, the experience for both the customer and for the brand. It's very emblematic of the type of investing we'd like to do, where it truly is win-win. It's a win for the customer. They have a better experience. More money is kept in their pocket, and it's an all digital experience. And it's a win for the company, where the company benefits and is changing the way financial services are delivered. Okay, so that's enough about Impression. Let's dive into how venture capital work.
Yes, so before we dive into how a VC fund works behind the scene, maybe it's better to start with a bit of context around VC investments. So here you have your whole options around investment as a startup. This is your whole list of investors. So depending on your stage, as a VC fund, we invest. We started pre-seed right to before IPO, and we are an option on the whole. In the whole growth cycle of the company. We kind of overlap with business angels when you look at pre-seed rounds, and we kind of overlap with PE funds in later stage kind of deals. But what is important to understand is VC funds, the earlier stage they invest, the riskier they are, in the sense that as companies grow and fail, the business gets de-risked as well. So early stage VCs tend to be riskier and higher return than later stage investments. Who are we? We invest other people's money. So unlike business angels, for example, or like PE funds, for example, we are in the asset management business. In that sense, we are looking for a risk return adjustments in our investments. So if you look at the 7% average return for the S&P, we need to beat that for sure, riskier than the S&P. So we need to beat that. What do we invest in? We don't invest in technology. That's not the first thing we invest in. We invest in growth, and that's probably one of the most important thing. We look for growing markets, and we invest in companies where our investment can definitely help that company to grow and to grasp a bigger market share. So definitely technology is just an enabler, of that hyper growth possibility, but we don't invest in technology, we invest in growth businesses. Well, on the structure.
Yeah. So we invest in hyper growth. So how do we do that? This is a relatively straightforward legal structure. So we have to the top left, we have what's called the general partner. And the general partner is typically made up of a number of managers who are key persons in the fund. Below that, you actually have the limited partnership. And the main reason the structure exists actually is for tax purposes. In other words, if you were to invest all this capital out of a corporation and you got capital back, it is very likely that that capital would be deemed an income, a revenue versus a capital gains. And anyone in the tax business knows that capital gains are much better treated than revenue. So by having all the investments and disbursements in a limited partnership vehicle, you essentially ensure that the gains are taxed at a capital gains rate rather than at a revenue rate. And plus, of course, these limited partnerships are also flow-through vehicles in the sense that they're not a tax entity in of themselves. They just pass on all the gains directly to the individual, the person, whether it's an institution or an individual, and then they report on their own tax basis what's going on. But essentially, then, so of course that fund, of course, invests in other companies. But it's not so simple, unfortunately, because what you really find out is that when you really dig into this business, it actually gets to a relatively complex structure relatively quickly. So the general partner typically is like, for us, it's, Impression Ventures Capital 2, Inc. So it's not a name that you would hear on a regular basis. The name you would hear when you interact with us and what's on our business card is Impression Ventures Inc. And that's the management company. So the management company is essentially all the investment decisions are essentially given from the GP into the management company. And then similarly below that, again, thank you, the tax purposes, but below that you'll actually have parallel funds. And the reason you have parallel funds is, again, more tax reasons, unfortunately, which is if you have investors here in Canada, and this is very similarly in other jurisdiction, so resident taxpayers are put into one fund and non-resident taxpayers are put into a different fund, largely to separate the tax liabilities between those two groups of people. So as you can see, it gets complicated pretty quickly, and then it gets even more complicated as you have multiple funds. Because now you have essentially that structure which I just indicated across multiple different funds which are investing in their own series of companies, and they're essentially all reporting up to the management company. This creates some interesting situations. It's certainly that we've encountered. I'm sure other funds have encountered them as well. Because when you have an advisor for a fund, for example, is the advisor advising one of those limited partnership groups, or are they advising the management company? And so it in of itself not a deep philosophical question, but it's one that doesn't keep me up at night, but certainly makes me go hum late in the evening, if you will. So I wish I had great answers to that, but that's sort of, so it can get complicated pretty quickly when you're dealing with funds that have venture firms that have multiple funds under management.
Yes, so we're going to talk now in more details about the LPA, so the limited partnership agreements, the management of the fund, so the management company and the general partner, and the limited partners of the fund, so the investors. So first, the LPA. So it's a contract that is actually signed between the LPs, so the investors, and the general partner. It sets all the terms of the fund. So you'll have the investment strategy. Here you'll find the fees, you'll find the duration, like if it's a 10-year fund, or you'll find all the details and the responsibilities of the GP and the LPs as well. You have among the partnerships, you'll find LPAs that go to more details around the investment strategy. So you'll have LPAs that tell you, you have to invest in seed companies only from 1 to 2 million, or LPs that don't give you this kind of granularity in terms of details. But what is common to all LPAs is it clearly says that the GP has to invest and act in the best interest of the LPs, like all the time. Every single investment and action is to be made in the best interest of the LPs. This document is a private document. You'll never, as a founder or anyone else, actually have to have the ability to read it. That being said, the investment strategy and the investment strategy is typically disclosed on our websites, or happy to actually tell you more a bit about that, as we did at the beginning of this presentation. And as a founder, it's going to save you a lot of time to understand that and to talk only and to target only like fintech VCs or early stage or later stage or anyone, but it's going to save you a lot of time to understand what are the investment strategy of the VCs. The fund management, so we talked about the difference between the management company and the general partner. So the management company typically controls the general partners, the multiple general partners, and is a separate legal entity that owns the brand of the fund and goes beyond the only the GPs and the life of the funds. And this entity is usually responsible for all the expenses, so operating expenses, salary, office lease, like phone bills or conferences or anything else. The investment expenses typically come out of the pocket of the fund. So paying the auditors, paying, like if you have to go to a board meeting, for example, that would be an investment expense, but that doesn't come out of the pocket of the management company, but out of the pocket of the fund. General partners, they are legal entities, so separate legal entities again, and they hold the liability for the partnership. So limited partners or the management company cannot be pursued for any against any legal action or anything. That's a general partner. So they had to really have their limited liability. Yes, the life duration of a GP, it's gonna exist only during the life of the fund, and it's going to shut down as soon as the fund is closed. That's a particular theory of the GP. The GP is in charge of managing the fund and taking the investment decisions. Typically, that would be given back to the management company, this whole investment decision and responsibility, but that lies with the GP in the beginning. And again, the GP must manage the fund in accordance with the LPA, which is the governing document and the most important piece, the most important document. Yes, we'll talk about that more later, a little bit later, but it's mentioned here. The GP owns like a small percentage of the fund. Typically, the share, it's just a nominal share because they have to be in the partnership. But the partners who are involved with the GP, so typically who we call the general partners, so that would be Christian and Maur in our case, but they would typically invest in the fund as well. And the industry average is 1%. So the GP, you expect the partners of the GP to have an ownership in the fund. So like industry average of 1%.
Yeah, so you know, obviously a good sign of a strong manager, of course, is one that has more than 1% as a limited partner, right? And I think the view there is you want as much GP and LP alignment as you can, because what's good for, in that case, what's good for the GP then is good for the LP. And LPs ultimately are the bosses of venture capitalists. They are the, you know, well, even though they're limited in the sense of a legal liability, they are truly the shareholders of the fund. And they're broadly broken up into two separate groups. You know, group number one are institutional investors. And probably the most predominant group out of that, in the US anyways, is foundation and endowments. These are long-term investors. So the typical fund is a 10-year fund, usually 8 years plus 2 years extension, which aligns pretty well with the average duration to exit of a venture capital deal, which is in the US, I think is like 8.2 years. So you think of, you know, by the time the average is 8.2, after 10 years, given a normal distribution, the vast majority of the deals will either have gone to zero or have exited in some capacity, and you can unwind the fund. Occasionally you'll have deals that go on beyond 10 years, and obviously in the LPA agreement, there are rules to stipulate how that's dealt with. So if you think about who then fits with that investment profile, your money's going to be locked up for 10 years. Most people are pretty allergic. So the individual retail investor would be extremely allergic to that. Because typically they need the ability to have liquidity very quickly. So retail is out. So we need to align our duration with the type of investors that are looking for that type of duration. So pension funds and endowments are obviously big. There's a number of fund of funds out there as well that invest for long duration. So that's to be expected. More and more we're seeing family offices, especially family offices that are run more like institutional investors entering the venture capital space. And insurance companies are also big investors in venture capital, given their especially have a set of long liabilities. Of course, you want to have a duration risk that matches that, so they'll go into a long duration fund like venture capital. Banks and corporates you're seeing enter venture capital on occasion. I think it's more from a strategic basis than it is a return of capital basis. And then, of course, you have individual investors, and sort of family offices are probably the biggest group in that bunch. And this is sort of family offices. I think somebody told me, if you've seen one family office, you've seen one family office. So they're all very different, and certainly that's our experience as well. But high net worth individuals, again, they're high net worth individuals who are looking for a long duration, risk adjusted return. And of course, the advisors of our fund typically are also the advisors of a fund, and certainly our case is no different, are also limited partners in the fund. So all important stuff to know, because while the initial check that you're getting from a VC, likely you'll really get no exposure to who the limited partners are. There are questions that are actually kind of worth asking, because there's in the short term, a big value add for most VCs will be access to the limited partners. In other words, if they have institutional investors, like in our case, we have financial institutions that are LPs in our fund, and access to those financial institutions to our fintechs, something that is looked forward to, and we'll certainly provide that. We also have access to our advisors and so forth. What's maybe not quite as obvious is the co-investment and pro-rata rights that a fund has. So in every single deal that we've done, and every single deal that we've certainly seen, as part of the terms and conditions of the round of financing, is this concept of pro-rata rights, which is I have the future, me as an investor has a right to maintain my ownership percentage. And by the way, I can pass those investment rights on to other people in my fund. And so certainly something that we see in later stage deals, like in C rounds and D rounds, is funds that can't actually absorb the entire amount because they just don't have that much capital left over in their fund, will actually give those pro rata rights to their LPs. And so, this is long-term thinking, but if you are an entrepreneur and you're thinking, who are the LPs of this venture fund, because they actually may end up showing up on my cap table sometime in the future. Technically they're already on your cap table through the fund, but they may actually end up directly on your cap table. So anyway, it's worth thinking. It's certainly not going to break or make a deal. So if somebody gives you a term sheet and you like them, you're not going to not take their investment because of this particular potential future risk. But I think it's just worth mentioning and worth thinking about. And then, of course, the GPs should be, like I said, GPs should really be big, reasonably large investors in their own fund, if nothing more as a show of confidence and alignment of interest. So how do VCs make money? You think it's relatively straightforward. We invest in companies, they have big exits, we make money, which is just not far from the truth, actually, very much is. But it's broken out in actually three sort of buckets. Near term and two forms of long term. So the near term one, obviously the management fees. Venture capital firms, for the most part, operate on a 2 and 20 model. Slightly different than the hedge fund 2 and 20 model, in that we don't take the 20% every year based on a mark to market. We only take the 20% carried interest on exit of the entire fund as a whole. So it's a lot less egregious than the hedge fund model. Even though it has exact same nomenclature. I just like to point that out. It's clearly a sore point for me. So management fees, most funds charge about 2% of the capital under management on a yearly basis. That typically will ratchet down after the investment period. Investment period is typically sort of 4 years, 5 years on the long end. The reality is when you really get into fund economics, as a GP, the vast majority of your gains as a GP actually come from your capital gains, does not come from carried interest. Now, you could have this massive 100x win, in which case possibly that the vast majority of your gains will come from your carried interest. But the reality is if you really model out multiple funds over a long time with a normal distribution of deal flow, the vast majority of gains actually come from capital gains, which is kind of an interesting standpoint, which goes back to best fund managers really should be investing in their own fund, given that's actually where you're going to get the most capital return back. Carried interest becomes then a nice accelerator, if you will, of that return of capital. Most VCs are not in it for the management fees. This is really the capital that's used. Certainly in our case, that's capital used to keep the lights on and to keep operational on a day-to-day basis and make sure that the team is staffed and that that we're doing all of the necessary fiduciary duties to manage the money correctly on a day-to-day basis. Is this super dry or interesting? Or just temperature check in the room? Okay, all right, thumbs up, excellent. So of course the fee structure is typically kept private, but on average it's pretty straightforward. Obviously in bigger funds, as you get into the multi-$100 million funds, 2% fee tends to start to come down. And it's just simply a matter of, if we go back to the original slide, sort of risk versus reward that Pauline put up, in early stage venture capital, the average 75-year U.S. historical return, I think, is around 20 to 24% IRR. So if you're making 22% IRR, no one cares if you're charging 2% a year. In other words, the difference between 20 and 22 is relatively inconsequential for you as an LP. If you're invested in a later stage fund that's generating 8% per year gross, and you're charging 2%, you're suddenly now at a 6% rate of return, which is now below what you get at the S&P 500. And so we're seeing some pressure in that in the current rate environment to drive down the much larger funds into a lower fee structure. Because the reality is, probably don't need 2% of a $800 million fund, for example, to operate the fund on a year-to-year basis. So why does this matter to you as a founder? It doesn't really, but I think it's useful to know. It gives you sort of an indication, or like, are the fund managers in it for the fees, or are they in it for the return of capital? And the reason you care for that is, all things being equal, you would rather have an investor at your table that's in it for the return of capital, because their interests are going to be aligned with your interests, which is to build a phenomenal business that's going to generate an outsized return. If they're in it for the management fee, the likelihood of them actually really helping you to build a business is not the incentive is not there as much. So just useful to know.
Returns, yes, so the nicest part of the job. So one thing that is important to understand, I guess, the biggest takeaway of this section is that VCs report return in terms of IRR, so internal rate of return. IRR is both a function of exit multiple and time holding period, in the sense that if you exit a company and it's a time 3 after 2 years, it's way better from a return perspective than exiting the company after 9 years and doing a time 10, right? So this is something we have to keep in mind all the time. It's both a function of exit multiple and holding period.
Is that exit multiple on the valuation of venture capital?
It's on the valuation of the capital we have invested. So going back to the fund level, same thing here. The investment horizon, we discussed that a little bit. So the average duration of a fund is 10 years, but we actually, VC funds actually only hold cash and funds for around 6 years, just because we're not in a cash management business. So we're going to call funds gradually. We're not going to call just 30 million from day one. We're going to call capital when we need it, so when opportunities arise. And we're going to also redistribute the proceeds of our investments when we exit funds, the company. Sorry, we're not going to keep those liquidities in our bank account. So we only...
We're positive for a second. I think it's a really important point that we're not in the cash management business. We do not keep cash in our accounts. So if you sign a term sheet with a founder on a Friday and expect to have cash injected into your account on a Monday, it's not going to happen, because we need to actually go to our LPs and ask them, hey, can you put money in our cash account so that we can fund our investments? And the cash always shows up because there's deeply punitive actions happen if you don't follow up your capital call. But it's just, there's a function of time there. Like, don't expect the capital to show up day one.
Yes.
Sorry.
That's okay, it's a good point. And the 6 years it's an average, and it's typically a bit longer for early stage funds that gonna hold positions for a bit longer, and it's typically a bit shorter for later stage funds that invest in companies at Series D, for example. So that's for the investment horizon at the fund level. Regarding the expected return, so again, we're in a risk adjusted return asset management kind of class, which is highly risky assets, and to be rewarded for this high risk, we are going to target a minimum of 20% IRR. That's what we are going to target. So if you take an example of a 100 million fund, that means that after 6 years, we actually want to return you 300. That is going to be equal to this 20% IRR. So 20%, if you give 20% or this 300 back to your LPs, they're going to be happy about it. Of course, you didn't lose the money and you made a good return, but they're not going to be euphoric, right? The best VCs do better than that. The truth is, the vast majority of them don't even get close to this 20%. So here is an historical average for the US VC funds over the years, and you kind of see that early stage VCs are doing a bit better than the later stage, but what you certainly see is VCs are doing worse than actually the Nasdaq and the S&P's indexes on average, right? So on that you'll have VCs that average like the 2%, and some that are have invested in Instagram and then are maybe probably way higher than that. So on average, VC is below those Nasdaq and S&P indexes.
This is a great example of like averages lie, right? Where it's like, so the 10th decile funds, which are not even on this chart in terms of the returns. They're way above it. And in fact, the Canadians are also on this chart. They're just so below the 5% line that you can't even find them. BDC back in I think it was April gave us the 5-year and the 10-year percentages for venture funds. The average of venture funds across 70 venture funds in Canada, and the numbers for 10 years was I think -5%, and the 5 years like -2%. So just to give you a sense of the venture class is very much a tale of two cities. You have a small number of funds that are vastly outperform, and then the vast majority of funds that underperform.
Yeah. So going back to our example of the 100 million fund, what is important to understand is in the VC space, the normal distribution doesn't apply to returns as per law, in a sense that half of the companies are going to die, and that's we're prepared for that, and we certainly don't want that to happen. And our job is to increase those odds of living. But half of them are going to die. So if you look at your returns, the big piece of it is coming from your winner, and you need that winner to be able to return those 300 to your LPs. Otherwise, you're never going to meet this 20% IRR. So what is important to understand in that slide is the biggest piece of the return is your winner, is your home run investment, and you need that. And what is important for you as a founder to understand that is because you need to show that to the VCs and to your investors. You need to show that there's a path to this 30x exit. You need to show that there's a way that you can be valued 1 billion, 100 million, let's start with that, at some point.
Well, go for a billion.
But you need to show that there is a path. Sure, it's unlikely, it may not happen, and our job is to believe in it and to help you to realize that vision, but you need to show that there is a path. Otherwise, if we invest in companies that are going to leave and do a 3x, we're never going to meet this 20%. And the last point is also very important. We've turned out great businesses. So we see companies coming to us that are great businesses. The founders are going to make a couple of millions a year. It's great, but it's just not for us in the sense that it's not going to grow to this 1 billion valuation. So it's not personal when we say no. Sometimes it's just, it's great business, a great opportunity. It's just not for us, and we're not just like the right fit and the right investors.
Yeah, so it's sort of the last I got 2 more slides as sort of general commentary, which is for my grab bag for all the other stuff that I couldn't fit anywhere else. So obviously we talked in a very general sense, maybe a bit skewed towards early stage venture capital, but of course venture capital in itself has multiple stages, from funds that focus on A to funds that focus on D, and you got the SoftBank's Vision Fund, which does I'm not sure what. But it's a lot of money going into some very late stage companies. But so the view of it is that the later stage, that the less risky the investment should be, and therefore the less expected return from that investment should be. And so depending on where you are, and the reason I bring this up is depending on where you are as an entrepreneur that's out there raising capital, just sort of shift the numbers a little bit based on where you are in the life cycle of a company. Fund concentration. I think this. If there was a right answer, we'd all be doing the same thing. So I think that's my sort of number one caveat. We run a very concentrated fund. Our thesis is very much that concentration. If you concentrate all your investments into a very small number of investments, any one outsized impact is actually have a multiplier effect on the overall returns of the fund. Vis-a-vis example, if you have 1/30, let's take to the extremes. If you have one investment and has a 30x, your fund returns 30x. If you have 100 investments and you have 130x, and you've invested equally across all of those companies, that 30x actually is a lot less impactful for the overall return of the fund. So somewhere along that spectrum from 1 to 100 lies the perfect number of investments that any one fund should have. I don't know what that is. I don't think anyone does. Our view is, our personal view is that 10 is the ideal number. And we certainly invest with that strong conviction, but we've seen everything from, is 11 that much different than 10? Is 9 that much different than 10? Is 20 actually that much different from 10? I think 50 is, and we certainly have a view on that. But the more concentrated you are, the higher the volatility of returns you expect. Of course, if you diversify perfectly, in the sense that if you invest in every single thing out there, your expected returns will be the market. Kind of just sort of makes sense, which means but your expected returns are 7%. So if you're perfectly diversified, it actually doesn't make sense to me from a venture capital perspective, because remember, your returns will be 7% minus your fee. Let's say it's 2%. So your expected return of net return to your LPs will be 5%. It's kind of underperforming. So we're thinking about it from those perspectives. Again, another common thing that venture funds do is they reserve capital for follow-on investing. There's been a couple of studies that have been done out there where funds that are targeting a 20% return can generate basically a 27 to 30% return based on simply follow-on investing. And so it's pretty common practice now today to reserve half of your capital on for follow-on investing into the deals that you're invested in. Fund size, obviously you want to look at, the VCs you're talking to. How big is their fund? Can they still write checks out of it? How many deals do they have left? Most VCs will constantly be in fundraising mode. One of my common topics that people come and see us to ask, I'd love to get into venture capital. I go, do you love fundraising? It's the first question I ask them. And they go, no, I hate fundraising. I'm like, well, then venture capital is not really for you. Because we're portfolio managers, and portfolio managers need to be out there raising capital. Otherwise, we don't get to invest in startups. So most fund managers will be out there raising capital on a regular basis. And then, of course, the more exits a fund has, the more likely they'll have more capital to invest into deals. We've talked largely today about, how are we doing on time? We're doing okay on time. We talked largely today about sort of the common model for venture capital, right? The sort of the typical GP-LP structure. There are a lot of other different models out there, and we just have time to talk about all of them, and we're also less familiar with all of them. But I wanted to sort of put four sort of fairly common models that we see out there. The first is sort of the deal-by-deal fund structure, or the angel syndicate, what we're seeing out of AngelList. And these are really sort of, you create a GPLP structure for essentially every single deal that's done. Amazing economics for the GPs. Why? Because you get carried interest on every single deal. So you can make 100 investments, you can have 99 wipeouts, have a net overall portfolio return. But if that one deal returns, 6%, you're walking home with a carried interest check. The economics for LPs are also amazing if they're really good at picking the winners. If the LP goes into that one deal that does 100x, then the LP is doing amazing. I'm a little, as you can see, I'm a little bit, I have some skepticism towards the single fund model, because I think it genuinely hurts LPs, because the LPs are just not going to be better deal pickers than the GPs. By very definition, the GPs should be there. They're being paid to go pick deals. If you either trust them or you don't trust them, if you trust them and invest uniformly across all their deals, and the best way to do that is through an LP structure. So anyway, I'm a little skeptical of the whole deal-by-deal model as an LP. Short duration funds, these are kind of an interesting little innovative thing that we've seen recently, which is basically raise capital on a year-to-year basis and get all that capital deployed. The challenges, I would say, with it are more related to conflict of interest between funds. So if you give your pro-rata rights from one fund to another fund, different set of LPs, are you giving those pro-rata rights, like the knowledge you have of an excellent company, are you using that knowledge to benefit a non-current investor? Possibly. Of course, if you're comfortable with that as an LP and you're going into this fund knowing it's a short duration fund, then that's what you're buying. So that should be something you know about. For you as founders, it's just useful to know. Again, I think the more information you have, the better equipped you are. Corporate funds. Corporate funds really measure the returns not based on. Now they'll say that they're measured based on the return of pure return of capital, but they're really what we see out there, what we see actively out there in terms of their incentives, is that they act in the sense that they're being measured by the bottom line of the company as a whole, as their parent company as a whole, which is it's not good, it's not bad, it's just different, and it's worthwhile knowing. And then evergreen funds. These are funds that exist in perpetuity, essentially, and only get to reinvest capital when they have exits. It's really an investment vehicle for extremely long duration funds. So this is something that a pension fund, with like a 50-year view of things might set up. There's nothing necessarily bad about it, nothing necessarily good about it. It's just a different model. So that's the end of my grab bag. I'm a random subject, so we have time for a couple questions.
Do they fall into one of those models, or are they creating new models?
They typically fall into what I have seen has been kind of a cross between the angel syndicate model and the question. Everyone here, the question is how do startup accelerators, incubators, how do they fall into this business model? And I would say that it's kind of a grab bag across the board. They have an extra challenge, certainly with my experience, it was about 6-7 years ago now with the X36, which is set up as a charity, and it had a investment vehicle alongside with it. So they have some extra challenges from a structuring perspective, the fact that charities aren't really in a position to invest in startups. So how do you get around that relatively big problem? So they figured out a way around it. But I have seen most of the time there being sort of the LP model. Good question, though. Any other questions? Frank, over here.
Is the concentration of a fund always stated in the LPA, or is that like you have a general idea of how many investments you're going to make and the relative size of them, or do you kind of make it up as you start to invest?
So So most funds in their LPA in their investment mandate will stipulate the size and shape of the type of investments it would make and what the rules around those investments are. And you know, again, there's extremes in specificity. There's one extreme which is basically gives the GPs complete leniency to do whatever they want, as long as it's in venture capital and including doing venture debt. On the other end of the extreme will be you know, very, very detailed investment mandates that if you defer it all from if you shift it all from that, you actually have to go to the Limited Partnership Advisory Council or Committee to get a dispensation for doing that change. That's the LPAC. We didn't really talk about the LPAC, but LPAC, think of it as your board of directors. We can't call it a board of directors because that would make them that would breach the limited liability shield, if you will. So they're called the Limited Partner Advisory Committee. But basically, anytime a fund wants to do something that's against the rules for all intents and purposes, they can, as long as they get permission from their LPAC. Any other burning venture capital questions?
So I guess so much of your time is spent on due diligence on the founders, on the companies and whatnot. What would you suggest is like appropriate types of due diligence that they should perform on you or on the VCs, the investors?
Great question. So we advise, and actually it's not even from my time as a venture capitalist. When I was in the Valley as an entrepreneur raising capital, I got very good advice almost 16 years ago now. And it was go look at the portfolio page of the VC and start calling founders. That's in their portfolio, and that's the advice I give to this day. So it's not my advice; it's advice that was given to me, and it's really your best way to give due diligence. What I typically find is like allocate an hour. The first half hour of that call, they're going to tell you how wonderful the VC is. And then you're going to have a nice conversation with them, and their guard will eventually come down, and then it'll tell you the truth. Which may still be that they're wonderful VCs. But I remember one particular call I had with one founder, and it went exactly that way. The first half hour was how wonderful the VC was, and after should you deal with him, blah, blah, blah. And then we started just chit-chatting, and then the last 20 minutes he told me how horrible this guy was. And how he was a nightmare on the board, and like it was just, and I'm like, should I still do the deal with it? And I'm like, he's like, I'm not so sure. I'm like, okay, that's a solid no. Yeah, so, ask around. What I found is my time as a founder, and I'm sure it's no different today, is, founders love talking to each other and helping out and supporting each other. That is your number one best resource to do due diligence on a venture fund.
Is it true that the U.S. VCs are more risk takers than Canadian VCs?
So I don't know where, I kind of know where that came from, because if you look at the genesis of venture capital in Canada in the sort of late 90s, they all came out of banks. Every single bank in Canada basically launched a venture fund at one point or another, and they staffed them with bankers, with their friends, like the people they knew. And so I think that did create a cohort, if you will, that many of still exist today, that do have at their very core culture more of a banker culture than an entrepreneurial culture, and that does drive less risk taking than their U.S. counterparts in the same sort of vintage, if you will. But I don't ascribe to the notion that Canadians as a whole are less risk takers than Americans. That is actually genuinely false. I mean, if you just look at the venture exchange and the mining deals that get done, they're extremely risk-taking deals, right? So we know, as Canadians, we are absolute risk takers, and we know how to take risk. I just historically, I think that's been skewed in the venture space given sort of the players that have been involved. I think that has largely changed today. I mean, if you look at the number of new venture funds that launched in the last 5 years, Impression included, they're much more founder-led, they're much more entrepreneurial-led, and I see them taking a lot more calculated risk than historical funds have been taking. All right, is everyone still awake? All right, now look, this is a subject that's near and dear to my heart. I could talk about this stuff all day. I find it super fascinating, but I also know that I'm really strange. So I understand that this might not be the topic for everybody, but hopefully you guys learned something about venture capital, what drives us, what motivates us, and that is useful to you as founders.